Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Tony Davidow. Tony is a senior alternatives investment strategist at the Franklin Templeton Institute, leading institutional research and thought leadership on private markets, portfolio construction, and goals-based investing. He hosts the Alternative Allocations podcast and works with advisors and institutions to translate complex strategies into practical frameworks. He's previously held senior leadership roles at Morgan Stanley, Guggenheim, and Schwab, and began his career at a New York-based family office. So what does this mean? Well, it means that Tony is a rare combination of finance and portfolio construction. He's about to do and tell all about it right now. So Tony, welcome to the show, man.
Boy, with an intro like that, Brian, it can only go downhill from here. Thank you so much for having me. I'm a big fan of your show. And as a fellow podcaster, I realize this is a great way to reach an audience.
Yeah, it's a great way to connect. And boy, you've got such an amazing background with your time right now at Franklin Templeton and everything that's come before that. So let's dive in, brother. I've been meaning to ask you, most portfolios, they're still built on a 60-40 mindset. But from your vantage point, what is structurally broken about traditional portfolio construction today, and how should allocators rethink the foundation before even introducing alternatives?
Yeah, I think this whole notion of a 60-40 portfolio probably went a little farther than it should have. I think it was originally introduced as a market proxy to say, I'm going to get growth out of my equity allocation. I'm going to get income from my fixed income allocation. And in theory, because they're not supposed to move in lockstep with one another, I'm going to get some diversification benefits. And as you and I know, that hasn't been the case. And in fact, if we go back to 2022, what we found is the 60 and the 40 were both down double digits. And almost every time that we've had a shock over the last 10 years, we find most traditional investments move in lockstep. So I've been an advocate for quite some time saying that it's an outdated, incomplete toolbox. And what we really need to do is take the basic tenets of it, which is we want to have investments that don't move in lockstep with one another and use different sort of tools to have a higher likelihood of achieving outcomes. And to me, that is the role of alternatives. These are precise tools that can be used in pretty unique ways.
So 60-40 we'll say is dead, right? This portfolio allocation. I'm being a little dramatic on that, but there's a better way. So that's what's wrong. But what can they do now?
Yeah, I think the reality is, again, if we think of the basic elements of it, that diversification matters, that still holds true. It's just to think that the entire investment spectrum is stocks and bonds, that's just a little incomplete. And, the good thing is today, we have a lot of tools at our disposal. We have, private markets and public markets. We have hedge funds. We have strategies that can do well in difficult periods of times and others that can deliver outsized returns. And now we've got a much more robust and durable toolbox. Why wouldn't we be taking advantage of it? And I know we'll get into it, but we also have these great lessons learned from institutions and family offices who have used alternatives in a very meaningful way for decades and decades. So this isn't new. It's just how do we make this more commercially available to everyone?
Yeah, and I'm glad you bring that up. And what I think, Tony, is that this tees up a lot of what I've been preaching from this pulpit on Making Billions, which is I think we're about to enter the golden era of alternative assets. And here's why. So I think that the issue that is leading to the rise of alternative assets and alternative asset managers is public markets, I think, are highly efficient. Meaning, if you follow the efficient market hypothesis, it says basically in an efficient market, the price reflects all available data. And so it's really about how much of available data is actually priced in. And we do a really good job. In fact, America is one of the best. They pump out tons of information, a lot of transparency. And so it's really hard to generate alpha when you're not surprised. When there's wide consensus and we all agree on what the price is, it's really hard to generate alpha. And I think that's at the root of why they're doing the family office strategy. And a lot of mainstream managers are going to be asking for alternative asset deals because it's not as efficient.
I agree with you 100%. I'll add two little data points on that. One is the public markets are shrinking. So the public markets are half the size they were just 2 decades ago. The private markets are growing. So not only is it a different return pattern, it's a much richer opportunity set. So to me, that's what's really exciting. We now have the ability to invest in these young companies that have more of a dynamic sort of range of growth over time. To your point, the public markets, everything is known. You're going to get a lot of volatility around noise and all of that. But at the end of the day, all that information is readily known in the marketplace. And unless something fundamentally changes, there's not that huge opportunity for the upside that you get with private markets, which are inefficient. That's really the essence of what David Swensen talked about. David Swensen, of course, the famous CIO of the Yale endowment. And he focused on the inefficient parts of the market are really where the opportunities are made. And he, through much of his tenure as the CIO of the Yale endowment, had a 70% 70 to 80% allocation to alternatives broadly, and a 40 to 50% allocation to private markets. Why? Because he thought that's where he could generate the excess return.
That's brilliant. And many investors, they add alternatives as a sleeve instead of a system, right? So there's still a little bit of an old idea, but I think a lot of people are waking up. So how would you recommend allocators define the role of alternatives inside of a portfolio before they even decide which strategies to use?
Yeah, I'm glad you brought that up because I think you're 100% right. I think that a lot of people think, I have a really robust process when I think about how I allocate my traditional capital. I'm thinking about my long-term strategic allocation. I'm doing the due diligence and the manager selection, putting together a portfolio. And then sometimes you think of these alternatives as products and you don't go through the same process. To me, I just expand that whole process that we've developed, whether you're an institution who has a really formalized process or an individual investor, I would just expand the aperture and really focus on what is the role for each one of the individual investments I'm introducing. And if now I've expanded my toolbox to include private equity, I'm adding private equity because I want to get incremental returns. I'm adding private credit because I want to get more income in my portfolio. I'm adding real estate maybe because I want to have a little bit of a buffer for the volatility that I know will occur over time. So if we start to think about it in the same sort of way, that what is the role of it and ultimately how does it fit into our other investments, we're going to have a much better outcome rather than putting it to the side and thinking I've got a really robust process for all my traditional stuff and I've got this product over here.
So I call it the Giddy framework, right? Growth, income, defense, and inflation hedging. And so if you're feeling giddy, but I think what you're saying, and this is a really important message that I don't want to gloss over, which is saying, well, yeah, growth, income, defense, and inflation hedging, right? That's not new. A lot of people want that. We hire professional managers to help get our portfolio to adequately reflect growth, income, defense strategies, and inflation hedging. But what we're saying here is that, but in alternative assets, you can get that. And it's very attractive. So instead of just doing stocks and bonds to accomplish that, you will, but you might be suffering on a little bit of growth. And like you said, those markets are shrinking, private markets are increasing. So you can still get the outcome that you want on your portfolio of whatever combination of this Giddy framework is. But you can do it through alternatives. Is that what you're saying here?
Exactly. And again, I would say that, you've kind of framed it appropriately. There are really four primary goals that all investments play: growth, defense, income, and inflation hedging. All investments fall in there. We typically think of that with our traditional investments, but why not think about it the same way when we think about our alternatives? I view alternatives broadly as more precise tools. I can be much more precise. I can get different sort of experiences over time because, again, if today most traditional markets are highly correlated, I'm not getting that diversification advantage over time. And I think oftentimes we use these tools and we say, well, we've got X amount of different asset classes in the portfolio. That's great. I'm getting diversification. But oftentimes they're still highly correlated and they're still responding to the same sort of shocks to the market environment. So really the role and value of alternatives is expanding that toolbox to have better outcomes, whether it's higher growth, higher income, better defense, or truly hedging the impact of inflation, which is something we hadn't had to think about for a while. But I would imagine it's front and center for a lot of the folks on this call.
Mm-hmm. Yeah, you're spot on. And just dovetailing off of that, I've noticed that one of the biggest mistakes investors make is maybe missizing alternatives. So how do you think about sizing when it comes to this? Like, for example, sizing in private equity, private credit, real assets, just so that they can meaningfully impact outcomes without breaking liquidity or risk budgets?
Yeah, and I think that's really the way that I start the discussion is I think you have to allocate enough that matters. I can point to all of the data, and Ryan, as you know, we do a lot of research on how institutions and family offices allocate capital. Institutions typically are 30 to 50% allocated to alternatives, but what we find is often the largest institutions, the Harvards and the Yales, the CalPERS and the CalSTRS, will have substantially higher allocations because they can. We see family offices are roughly a 42, 43% allocation to alternatives. Now, in the wealth channel, this is still relatively new. I don't believe that somebody's going to go from 0 to 20 to 30 in one fell swoop, although clearly there are sophisticated advisors who are using larger allocations to have better outcomes for their clients. But I think that one of the things we have to think about is if we're going to make these decisions, we have to do enough to really change what happens in the portfolio. So that means we've got to make a meaningful allocation. It may mean that we have to get there in steps. Maybe we start with a 5% allocation, then 10, then 20. But ultimately, we want to have enough in the portfolio that we actually have a differentiated return pattern over time.
Okay. Do you have a minimum amount that you think it really starts to make a difference? Because you mentioned before as saying missizing or underfunding that or overfunding it. Is there a place where you say, here's where it starts to be worth your time? Is there a percentage that in your opinion, that you feel like is is a good one for folks to look at?
Yeah, I think across the wealth channel, we think a 20 to 30% allocation makes sense. Now, that's broadly. There may be some individual investors who they have zero, and it's not appropriate for them because they don't have the time horizon. I'd also offer that, with institutions, oftentimes it's, yes, I have a 30% allocation or 40% allocation, but the question is, what's in that allocation? Right. So if I'm a pension plan, I'm probably focused more on generating more income in my portfolio. So I'm probably focused on strategies that would generate more income. So it's not just the percentage allocation, it's what's in that allocation. Now, institutions do that because they're large and they can make those discrete sort of bets along the way. It's only relatively new that in the wealth channel, advisors and investors can start to think about diversified exposure, which I would always argue diversified exposure, getting a little private equity, a little private credit, a little private real estate is better than putting all your chips on one investment.
Yeah. Something that when we first met, we had a good discussion around interval funds or these evergreen funds, and they're starting to really rise to the top. I mean, they feel new, but they've been around for a while. What are you seeing out there as it relates to this and interval funds coming in and playing a role of driving alts into the mainstream?
It's interesting because you're right. The structure has been around since the 80s, but it was really post 2008, after the global financial crisis, that structure started to be used primarily for private credit strategies where you could hold illiquid investments. I like the term evergreen or perpetual because I think it's more descriptive of what they are. And what we're starting to see is a lot of institutions and family offices thinking about using both the traditional drawdown fund, kind of the first generation of fund, and these evergreen funds. And I think that's an important distinction because I think sometimes people think they're watered down versions just for the retail market. I think that institutions and family offices recognize part of the value of it is from an asset allocation perspective, I'm getting that allocation right up front, right? I'm typically investing all of my capital or most of my capital up front rather than the first generation drawdown structure where capital is drawn down over 3 to 4 years. So I decide that I really like private equity, but I'm actually not getting that full exposure until 4 years out. The evergreen allows you to get that more immediate exposure. So I think for institutions and family offices, they're now starting to think about how to incorporate both. I think for the wealth channel, they've clearly become the structure of choice. And I know you had Kim Flynn, a friend of both of ours, on your program before. And Kim, has really done a terrific job across the industry, kind of helping us all think about the growth that's going on. Not only the growth in the number of funds, which is, I think, over 300 today, but the assets and the types of strategies that are coming to the market now. So to us, we look at this as a really effective way for an advisor who may have hundreds of clients to allocate across the entire book, as opposed to a handful of his clients who could get into a drawdown fund and miss out on the great opportunity. So I think it's a really exciting time. We're also starting to see world-class managers bring products in that structure. And I think that's the other thing we need to be mindful of. I don't want to have a manager who's never done this before. I think in the private markets in particular, you definitely need the experience and seasoning to allocate capital appropriately.
Okay. And you mentioned earlier when in this discussion, we were talking about the differences between public and private, and there's many. And private markets do behave also differently. It's not just the profit profile and the asymmetric information, but they genuinely behave differently than public markets. But many investors just don't adjust their expectations. So in your opinion, how should allocators mentally and structurally differentiate private market risk, return, time horizons from those that are common in public markets?
I would say the biggest impediment that I hear from advisors and investors is illiquidity. And I'd argue illiquidity is just a feature. It's not inherently good or bad. But in order to capture this long-term illiquidity premium, the 300 to 500 basis points that you get for private equity relative to public equity, you have to give the manager a period of time. Typically, that's a 7 to 10 year period, might be 12. Some of the durations of these funds are stretching out a little bit. But ultimately, what you're doing is you're allowing those young companies to fulfill their destiny. You're giving them the freedom to think long term, as opposed to public companies, which are really beholden to answering to shareholders on a quarter-over-quarter basis. So to me, I think a lot of companies today enjoy being in the private enterprise. And if they can get access to capital, which they can because there's an abundance of capital, many of those companies will stay private longer, which is a good thing. And maybe just to put a point on that, you and I were talking earlier about SpaceX, and SpaceX will likely go public in 2026. The valuation that I've heard is something of the magnitude of $1.5 trillion. But it's also important to note that SpaceX was founded in 2002. It's a 14-year-old company. It's a very mature company. But I think smartly, they decided to remain private so they could actually execute a very complex strategy rather than imagine if they were a public enterprise and every time, one of the lifts didn't work the way that it was supposed to, you get the scrutiny from people looking over your shoulder or people want to understand how you're spending capital. When you're in the private domain, you don't have to do that. You have the freedom to do what you think is best over the long run. And I think the SpaceX example shows us how you can be handsomely rewarded when you ultimately do come to the market, if that's the path you choose.
Yeah, and that would underscore the benefits of being a private company is, like you said, is you're now positioned to look and execute on the long term, which ultimately leads to going the long distance and creating valuable assets with your company. I think is key. And if you're just going by how do we nail our numbers for next quarter, it creates a very different dynamic. It still works to some degree, but I think especially when you're a builder and an innovator, a lot of these things are multi-year campaigns. And if all you're doing is getting squeezed and pressured to just nail it next quarter, you're like, well, if you think in quarters, I'm not going to nail it until I do. And so I think you're right. A lot of these companies are like, maybe the IPO too early is not the goal. Maybe it's just pure excellence in our company and performance in our company and build really great assets that bring value to the company. And that requires us to think beyond 3 months at a time.
Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
Yeah, and Ryan, I think I gave you the example when I was at Morgan. I work with a lot of our investment banking clients, and I work with the Google executives. And when Google went public, that was really the only path to monetize the opportunity, and they went public and made a series of acquisitions. But to your point, now because there's so much capital available to these companies, they can make acquisitions, they can do things, and they can choose to go public when they think appropriate. Or many of them may say, "I'm never going to go public because I really don't need to go to the public market." So I think for the folks on the call, one of the things we need to do is kind of rethink how we think about public versus private, because they will represent, these private companies are going to represent a lot of these oversized opportunities if we can allocate appropriately. And again, I would always think that that's not something that you and I are doing on our own. We're typically, farming that decision out to somebody who has a lot of experience, has been doing it for decades and decades. But we've all seen those oversized returns coming from private equity allocations.
I love it. Now, you've been a longtime advocate of goals-based investing. So how does a goals-based framework change the way portfolios should be constructed once alternatives are included into that full pot?
Yeah, I think a lot of institutions and family offices use some form of it. They may call it outcome-oriented investing. But I think they typically believe that all of these tools are in the portfolio to provide certain sort of outcomes over the long run. I think in the wealth channel, it's a little bit more challenging because I think the temptation is the advisor's value proposition. I don't think that's the case, but I think a lot of times it's the way that it's kind of painted. The advisor's value proposition is outperforming the market, which is very difficult to do and probably not the best way to allocate capital to start with. Wouldn't it be more constructive to really start by understanding what it is that you're solving for, focus on investments that give you the highest likelihood of achieving those goals over time? So not to get overly geeky, I would just change the utility function from maximizing return, which probably isn't the best thing to do because maximizing return means we're going to take a lot of risk, and change the utility to whatever that goal is that we're trying to solve for. And that could be income in my retirement. It could be capital appreciation because I've got a long time horizon. It could be dampening portfolios and wealth preservation because I'm concerned about risk in the market. But if we change the utility to focus on what is the outcome and assemble the right asset classes that give us the highest likelihood of achieving, I think everyone wins in the long run.
That's brilliant. You mentioned before that illiquidity is just a feature. It's neutral. It has no meaning other than what you prescribed it. You didn't say it like that, but I did. Now, often though, when I think you understand it in a healthy way, but often what investors will hear from portfolio managers, as an example, is that it's often framed as risk. So with that being said, how should allocators reframe liquidity as a design choice? And how do you decide what should be liquid versus intentionally illiquid?
Yeah, and I think part of that is driven by the fact that it's not the rational sort of discussion. So Ryan, if you and I were sitting down and I showed you all the data on a piece of paper of the historical risk-adjusted returns of private equity versus public, like you would do that all day long. But it's that emotional sort of response. And emotionally, we all fear, we're humans, giving up control of assets. So that's the same if you're an advisor or an investor. That's the same if you're a trustee on a board, right? You don't want to give up control because you lose the ability to change what goes on over time. So I have long been an advocate of developing what I refer to as an illiquidity bucket. So what if in the beginning of the relationship, we actually sat down and said, just realize these are long-term investments. We should think of them as 7 to 10 year investments. But let us think about it in reverse order. Let us think about how much of your capital would you be comfortable tying up for that extended period of time? Well, that becomes my patient capital pool. I don't touch that. I don't do anything with it. If there's volatility and shocks to the market, I'm not going to touch that. It teaches me actually to be a long-term investor, which is a good thing. But what I can do is with my traditional investments, if the markets are volatile, I can de-risk my portfolio by taking away from my equity allocation and adding gold or cash or something to de-risk the portfolio. Or if I want to be more tactical and opportunistic and chase returns, I can take it from my traditional pool of capital. But I think if we can actually carve it out and treat it differently, it actually instills in us this discipline, which I think would be very good because we'll ultimately reap the rewards over the long run for letting the manager do what they do best rather than that emotional temptation, which is to head for the exits at the wrong time and get back in the wrong time.
Got it. So we should just embrace it, and it helps you to be that long-term investor. So we're saying, I think what you're talking about is illiquidity can actually be a strategy. And I remember as you were talking, I recall speaking to a good friend of mine. I think she was around $1 billion under management. She built this fund up from scratch in like a few years, and she was saying that the more access we have to liquidity, so as a feature, if the more liquid something is, the more volatile it tends to be. But also more volatile the investor tends to be, because, say a hedge fund, for example, you can get in and out of that deal in the same day. So when you have access and you can liquidate your stuff really quick compared to, say, private equity or venture has no liquidity. I'm being dramatic, but either way is to say, as you have access and you can liquidate quickly and you have a very liquid market, it also allows bad behavior from the investor who might say, and portfolio managers will follow their clients' wishes, but it can lead that the investor also understands that I can liquidate this fast. But that's typically leads to the buy high and sell low type of losing strategy when people get emotional. Any insights on that?
Yeah, I agree with that 100%. I think that in many respects, we're trying to protect investors from themselves, right? To doing the wrong thing at the wrong time for the wrong reason. Again, the emotional drives our activity rather than the rational. And you mentioned the efficient market hypothesis early on. There's also this assumption that we're all rational investors. Well, the reality is none of us are rational, right? We all respond to emotional stimuli. You and I are trained to resist it more than most, but that is the temptation that's out there. So again, having that patient capital, carving it out, treating it separately, I think is a good thing. It's going to lead to better results over the long run.
I love that. And I love that you call it patient capital. That's a great term because it also ties into the psychology of what we're just talking about. And we're talking about re-educating the market and just a paradigm shift and saying, how does it work? If we up our allocation to alternatives, how should that be? But you bring up a great point is to say, how should I be when I'm investing in that? And that is key. So based on your work, educating advisors and institutions, what are the most common and most costly mistakes that these allocators are making when implementing them?
Yeah, I think it's really where we've been. It's this whole emotional thing, not thinking rationally. I think, again, the temptation is when something looks really hot, you want to chase it, whether you've really thought through whether it makes sense in the overall portfolio or not, or when there's risk in the market, the temptation is to head for the exits. And we all know, based on all the studies that have been done, is you end up missing out on both sides of it, right? You probably get out too late and you definitely get back in too late because you wait until the market stabilizes to get in. So the delta of what you get versus being in the market can be really, really big, especially in volatile periods of time. So again, I'm a very patient, disciplined sort of investor. I try not to look at my personal investments. I generally know what's going on, but I know that if I do, the temptation is to tinker with it too much. And I think most people fall into that trap. It's easy to tinker, and rather than let the strategy play out, make adjustments if it makes sense, but don't tinker too much where you actually take the ability away of actually generating those excess returns.
Yeah, no, spot on. Private investments, one of the features is they don't mark to market daily, but they're not risk-free. So in your opinion, how should investors properly set those expectations, say around, volatility, drawdowns, and even performance reporting in these private markets?
Yeah, I think it's a great question because I think a lot of people think there's some sort of funny accounting going on. Most private funds are marking to the mark on a quarterly or a monthly basis. By the way, Ryan, as you know, That's exactly what a bond manager does, right? A bond manager is looking at the prevailing market conditions and adjusting accordingly. Those positions don't change intraday. Like, you get a volatile day in the market and, stocks are swinging all over the place. And the reality is the fundamentals probably haven't changed that much. So I'm definitely mindful of the impression that people have out there, but there's nothing inherently wrong with that. The bigger question is, I want to make sure that whoever is doing the mark is actually doing it. And, typically there's a third party that's actually doing the valuations for them. I want to make sure they are adjusting the portfolios over time. But if you're thinking about it over 10 years, you shouldn't be thinking about intraday or even quarter over quarter. You should be thinking about, am I actually getting the long-term experience that I signed up for? And that's something you'll start to see over a longer period of time, not over these quarterly periods.
So really, I think what you're saying is bridging the gap is helping current investors who are used to stocks and bonds 60-40, even though it's not working. It's helping them understand exactly what you said, is that these products often, at least in the regard that I asked, they behave like bonds, and they're quite similar in that regard. So taking what they understand and extrapolating to say, this is quite similar to that.
Yeah, they're not going to bounce around on an intraday basis like the stocks will based on all the noise in the marketplace. By the way, I could argue that that's overstating volatility because the fundamentals of those companies probably hasn't changed that much. It's again, the noise, it creates a lot of activity.
Yeah. And that reminds me that even strong portfolios can fail if clients don't understand them. And we're talking a lot about the psychology behind it because there's a market shift and sometimes you educate the market to say, this is how investments are done now. So how do you coach advisors? Because I know you do. You've done a lot of that work and even through your show, but through Franklin Templeton, you're really good at that. So how do you coach advisors and allocators to explain alternatives to clients in a way that just builds confidence over the confusion?
Yeah, and I think that is one of the big challenges. It's, I would say that most advisors generally understand how private markets work, but it's that transmission to clients. As an industry, we sometimes make things more complicated than they should be. We tend to fall into jargon. If you and I were having a cup of coffee or perhaps a cocktail at the end of the day, we would very easily fall into terms like J-curve and capital calls and all of that. But we have to recognize that individual investors hear those sort of terms and they're like, whoa, this is risky because things you don't understand feel risky. So we need to find ways to break them down into bite-sized pieces. We need to explain things in a way that the individual investor can understand. So, one of the things I think we're talking about earlier was, I hear from a lot of individual clients that, well, I don't recognize the names of my private portfolio. I recognize everything in my public portfolio. I recognize all of those names. I try to remind them that most of those names that you talk about, Microsoft and IBM and Google, they were all private enterprises. And I describe kind of the journey that they go on to become a public enterprise. So I think we just need to remind them what these investments really are. We need to remove the jargon as much as possible. And every client is a little bit different. So, maybe we have to go slower and provide more visuals to describe how these strategies work. And others are going to grasp it easier. Maybe they're in the industry, but we need to be mindful of the fact that if we fall into the jargon and we lose them, they're going to feel like it's much riskier than it should be.
Yeah. And, their alternatives or alts, they're often sold as diversifiers. We're kind of talking about the sold as a sleeve more than a system. So they're sold as diversifiers, but they don't behave the same in every cycle. So, and I know we like predictable and we run correlation models and we try to extrapolate and understand. And sometimes these behave a little bit different. So how should allocators think about the role of alternatives across all of the inflationary, deflationary, stress market environments? Like how should they think about that?
Yeah, and they're not a monolithic set of investments, right? So private markets, again, think about the major food groups. Private equity is different than private credit, which is different than private real estate, which is different than infrastructure. They all have different roles in the portfolio. We haven't talked a lot about hedge funds, but hedge funds, again, can be offensive in nature. Long, short, or event-driven or more equity-baited plays, and then strategies like managed futures and global macro, more defensive plays. So we can't paint them all with the same brush. We should understand in advance what are the roles that each one of these play. Why do we have it in the portfolio in the first place? So I go back to those 4 primary goals that you and I both talked about earlier, and I try to slot those in. So if I'm looking for growth in my portfolio, that's where I'm going to add my private equity. If I'm asking, I want to generate more income in the portfolio, I'm going to think about private credit or maybe private real estate debt. If I'm thinking about defense, I'm thinking about real estate. Equity and debt both have negative correlation to traditional investments. They'd be a great shock absorber. And then real estate and infrastructure can help hedge the impact of inflation. So if I understand in advance the role that they play, I can then measure their effectiveness. But it would be a mistake to put all these ingredients together and measure them all versus the S&P 500. That's not really why they're in the portfolio in the first place.
Yeah. Then that brings me to my final question I've been meaning to ask you. So if you were designing a portfolio today for long-term capital with the, say, 10 to 20 year horizon, How would you architect it differently using alternatives compared to, say, those traditional models?
Yeah, if I were thinking about, a long-term horizon, a 20-year time horizon, I'd probably have a healthy allocation to private equity. But again, depending on the wealth of the individual or the institutions, I would probably want to have more diversified exposure. I think it'd be nice if you could have some private equity, some private credit, private real estate. If it's more geared towards generating growth in the portfolio, I'm going to have a higher allocation to private equity. If I'm closer to retirement or I'm a pension plan where I've got to generate income, I'm probably going to have more private credit and private real estate in there. So I can use these versatile tools in the right way if I understand what I'm solving for. But I'll go back to something you asked me about in the beginning. Again, if I have the time horizon and I have the wealth and I don't have need for my cash, I would allocate enough that matters. So again, if that's 20, 30% for individuals, that may seem high as a starting point, but ultimately I think directionally that's where you want to go. For institutions, I think we often see 30, 40, 50% allocations. And again, the larger institutions will have higher allocations than that from time to time.
Brilliant. So before we wrap things up, is there anything else you'd like to mention, ways they can reach out to you, the name of your show, the name of your book, like anything at all? Because this has been absolutely exhilarating for me, brother.
Well, Ryan, it's been great to be here with you. I love the conversation. We'll have to do this again. As you mentioned, I have a book, Private Markets, Building Better Portfolios with Private Equity, Private Credit, Private Real Estate. Very descriptive. It's available on Amazon. And then, as you mentioned, I have a podcast, Alternative Allocations with Tony Davidow, which you can get Apple, Spotify, or wherever you get your podcast. And then if anyone's interested, we have AltSpy FT. We have a knowledge hub, which has all of my white papers, my market outlook, blogs, podcasts, you name it. It's all kind of housed there. I never talk about product. Franklin Templeton has a great suite of products, but my role is really to help individual investors and advisors and institutions and family offices think about how to allocate capital and have better outcomes. So I'm sitting on the same side of the table as they are, and I think you are as well.
Love it, man. So just to summarize everything Tony and I spoke about, look to bring your alternative assets to the public markets. And understand that long duration thinking CEOs and structures are key to performance, and that's often found in alts. And then maybe the third one is work with RIAs and introduce yourself to them to see what is required to get your deals into the hands of these professional portfolio managers. You do these things and you too will be well on your way in your pursuit of making billions.